Hey, 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 welcome in, welcome in. We are back with another episode, and we're going to get into fundamentals today in how the infinite banking concept is definitely a way that you think about it. And we're going to come in from two different directions. One is really addressing something that comes up when clients have already basically set up the premise and the framework in order to practice the mindset of the infinite banking concept, and what can happen when you don't live it, and what kind of thinking takes place. And then the second piece is we have a brand new person who's checking out IBC with us and posed some really good questions that are common questions. And so we thought we'd take the time and space to answer that here, because it's a question that gets asked quite often. So maybe perhaps you can ask those questions here, Lacy.
Okay, drum roll to the questions. So I love questions. Questions are always good. And so when we are talking about setting up corporately owned dividend-paying whole life policies, how does the company go about when they take paychecks every month? So when they are paying their shareholders every month, do we keep the cash on hand to pay our monthly bills? Do we run all of our money that we can in through the whole life policies, or do we just run what we think we can? It's just all these questions, and I love it because their wheels are turning, and that gives us an opportunity to teach and guide. Let's go with the questions first.
Okay,
so
let's do it.
Yeah, so you're new here, you're exploring infinite banking, or maybe you just have policies set up that are new and you have some questions. So what do they do, Winnie? When they're taking a monthly wage, what do? Do they keep cash on hand to pay their monthly wage and their monthly bills, or what do they do?
So when you first get your policy set up, and I mean, every situation is like a fingerprint. It's just really, really different. And of course, when, to be able to sustain practicing IBC, you don't want to rush right into it. You want to get used to the flow of money coming in and out of your policy and knowing what that feels like and knowing how liquid it is. It is liquid. It's just a question of how much of it is liquid, right? If you're right at the very beginning, every single penny that you put into it, whether it's in the form of what was required or some of it may be optional money that you put in, if you're near the beginning of your first 5 years, guaranteed you're not going to have access to 100% of those dollars right away. And so because it's also designed where, especially if you're right at the very beginning, it's not like you can run 100% of your income through these policies either, because you just don't have the space for it. So it is a matter of, to this precise situation where, let's say if you're paying off another, whether it's your parents or some other business partner, and now they've got preferred shares going on, you owe them, let's say $3,000 a month or something like that. It helps at the start, if it's possible. Most operations already do have money sitting in the bank already. It's just a matter of how quickly they run through it. So there could be some advantage to sort of get a head run at the beginning, where it's taking existing stored capital that was just sitting in another account anyway and putting it in as a deposit option into their policy. Because you have to remember, life companies are not like banks. So we don't want to put unnecessary strain on our life companies of trying to do this month in and month out. It would be nice to sort of store up maybe at least 3 months worth of capital inside your policy loan. So let's say, again, you're paying out $3,000 a month to your preferred shareholders. So if you can gain about $9,000 inside your policy loan availability, it's kind of once you have that in there, what's kind of nice is you take that $9,000, take out one policy loan, right? And then that $9,000 then plops into your regular operating bank account, right? And you do the same thing that you would normally do anyways, where you would, each month you would pay out $3,000. It comes from the policy loan, but then you can do a number of things. You can then, that $3,000 anyways was going to come out of your account, before meeting with us, it was going to come out of your account anyways. But instead of paying it directly to that person, you're just going to now replenish the money that you took out as a policy loan and do it as a policy loan repayment back to yourself. And then you've essentially, and then every 3 months you can do that. You can take it out, put the money in your your operating account, and then do as you would normally do, $3,000 back as a policy loan repayment. And it's just about understanding why you want to do it. It's still cash flow management. It's still money in and money out of your account. But it's just understanding that when you put it in as a deposit option right at the beginning, it's lovely because now you have effectively created some extra room for buying paid up additions, which also forces you to buy extra death benefit on the life insured of that policy. So you're kind of indirectly making your cash increase because you're making the death benefit increase. Right?
So instead of our money, so I'm just going to speak like I'm a client. So instead of our money coming into our operating account, leaving it in the form of paying wages, paying our monthly bills, I'm going to contribute to my deposit option on my policy. And that's going to it's going to increase the death benefit on that life that's insured. It's going to compound, correct?
Yeah, because the death benefit and the cash value have to equal the same by age 100. That's a contractual rule. And so when we're doing things that purposely grow the death, like the permanent death benefit portion, it purposely grows the cash value as well, like the speed at which it grows.
Right. So now I've contributed to my deposit option. I've increased the death benefit. I've increased the cash that's accessible to me while I'm alive. And so essentially, instead of my money coming into my account, leaving my account and serving a purpose, the purpose of paying a wage or paying a bill, I've now made it do more than that.
I guess the best analogy that I can use, I think that most people in the agricultural world understand what it means to have an operating line of credit, or HELOC. Even if you aren't and you just have a HELOC, right? The bank will lend you a flat limit amount of what you can get, and you can borrow from that line of credit, and then you pay it back. And you pay it back so that you can borrow money again in the future. Except when you have a financial instrument like a dividend-paying whole life insurance contract that's set up correctly, it's like creating a line of credit that you own and control, except the limit on that line of credit increases every single day because it has to by contract. And so if you can visually understand that, well, before people met us, they understand what it's like to borrow money, right? They borrow that money and then they're in debt and then they make a payment back until they get to a zero balance, right? And so when we borrow money, from a lending instrument like that, we understand that we pay interest, right? But that interest is one of those things where we'll never get that money back and it's gone and done something beneficial, but for somebody else. And then we all opt in to pay for cash. When we get to a place, hopefully all of our business owners get to a place where they get to pay for things in cash, because that seems better than paying interest to somebody else. Because now we have more control. We can just pay out of pocket. We don't have any forced monthly payments back. And in our minds, we perceive this as zero interest. So what Nelson challenges us to rethink in the Becoming Your Own Banker book is that we are either paying interest to someone else or interest that we could have otherwise earned, which is the opportunity cost. So, which means that even when you're paying in cash, although it is the better of the financing option than financing it, we actually lose more in the ability to earn interest on our money that we could have otherwise earned. So every time you pay in cash, you are giving up interest you could have otherwise earned.
Well, I just think that it's always such a light bulb moment for people because it goes against everything that we've ever been taught about the banking system and about money, about the flow of money. And if you meet with us, we have this really good visual about the flow of money. And we show that sometimes whenever it's relevant, we do show that about the flow of money. And it's no different than if you are trying to change your eating habits or, what you're putting into your body, it goes against what you've done for so many years. And you're trying to retrain yourself to be into a different habit and a habit that seems completely foreign to you. And so money is no different. Our relationship with money, how we treat money, what we do with our money, it's no different. The next question was, do we put all of our money into the whole life or just what we think that we can?
Yeah. So as I was sharing before, like especially when you're starting out with infinite banking, it's impossible to run every single penny through these systems right away.
Mm-hmm.
And it's best, again, for your own like sustainability of living the financial lifestyle of the infinite banking concept. It's really important to take things slow and believe, like just get to understand the impact of like when you contribute to it, what happens, then what happens in terms of how much you have liquid to you. And that way you never feel like that friction point of feeling like, oh, this policy is like taking something from me. And it is a huge shift, especially if you're a person that is really used to like, you come from the world of like RSPs and liras and TFSAs and things like that, right? It is a very different process. I mean, I think that there's RSPs and TFSAs that are locked in because they like, depending on where you're holding it, whether it's like I don't know. There's just so many different places, whether it's at the bank or like investment firms, you can take it out whenever you'd like. And then there's some where you lock it in for a longer period of time to get a higher interest rate. And those are designed a little differently, and it may feel like you have access whenever you want it, but just know that what you are giving up is the liquidity of your money and the growth of your money. So if you have $100,000 saved up in an RRSP, and then when you go to take it out, especially if you were earning like, 4% on that 100,000, but if you go and take out 25,000, well, you're not earning 4% on 100,000 anymore. You're earning 4% on what is left over, which is now 75. And so it interrupts the compound growth of your money. Whereas this is what is also very distinctly different about this particular type of financial instrument. It's just set up in such a way so that growth that you're getting to experience on your money isn't being interrupted. So that is very different. And that is what's beneficial. And when you can finance the rest of your life this way, you are in effect going to actually just keep more money just because of that. Right? And that's without having to invest anymore or rely on the marketplace to make up for that difference. So that's something also to really consider and really sink in, which kind of leads me to what can happen. I mean, I think that there's a lot of advisors out there who practice infinite banking and they can brag about, oh, like I have like a 99% stick rate of all my clients and all that sort of stuff. And I have to say, like, that's just not realistic. Like you were saying, you can lead a horse to water, but you can't make him drink it. Yeah. And I think that there's a ton of people that really get into IBC with all the best of intentions, but this takes work. It takes a good kind of honest work of managing cash flow, which you have to do anyway. It doesn't matter what financial lifestyle you live, you have to manage it. And you have to manage the way that you're thinking in order to be successful at implementing this into your life. And so what was like that one comment that we got from a client who they got their policies 6 years ago and they decided to terminate all 3 policies. And
we've tried. That's what it was. We've tried.
Oh yeah, we've tried for 6 years to implement IBC. And what we don't like is the perpetual
borrowing and repaying policy loans.
Yes.
This is all about mindset. So
it is.
This is a mindset thing, because if I work for a full month and I get a paycheck, but then I don't work the next month, well, I'm not going to get a paycheck. So I have to, if I want to continue earning money, then I have to continue doing what it is that I have to do to earn that paycheck. I can't not do the work. So maybe that's a bunny trail, but it's like, if you're building something up and using it, you have to replenish it. So if I'm working every month to earn money to pay for my cost of living, but then I decide I don't want to work anymore, well, how am I going to pay for my cost of living? Like I'm constantly replenishing that source of income. This is no different. It's just a mindset shift in who owns the debt.
And it is about who's controlling the banking function in your life. So yeah, to your point, it's like saying, well, I'm just tired of earning money and then having I don't know. It's like you might as well just quit working then, if that's your excuse. And maybe it's just me sounding sad and frustrated and bitter and just wondering, is there more that I could have said and done to coach this person? And I guess at the end of the day, it's like when our clients become our clients, we are here and we're here to coach and train, and we're going to do our best to show up as much as we can. But, if you don't show up for your coaching or you don't call on us to be coached, then you are going to be left to your own devices, especially when the rest of the world is trying to tell you something else. Every time you go to the bank, every time you go out. And so if you're not within a community of other people who practice IBC or talking to your coach, or if there's podcast galore and we're one of those people echoing a certain sentiment out there, these folks got lost and decided that it's more of a burden than it was being seen as a way of empowering yourself in a way that's probably the safest that you could. Like compare that to getting into the world of cryptocurrency. That is so volatile right now, and it's so easy to lose your funds, right? And it requires way more education. We're talking about doing this instead of, buy term and invest the difference.
Yeah.
For some reason, that's seen as more safe than what this is, which is absolutely crazy.
And it doesn't matter what you are looking for. If you go on, my granny used to call it Goggle. If you go on Goggle and you start searching, you are going to find the answer that you're looking for. So if you want to go on there and you want to find out why this fad diet's not going to work for you, the old algorithm's going to feed you a million reels and posts about why that's not going to work for you. So you can go and you can find the answer that you're looking for to anything. But I think the real question that you need to ask yourself is, what is it, when it comes to the finances, what financial path resonates with me? And then you need to protect that decision, because like I said, there is content to support any which way you would choose to go. And if you're not protecting the choice that you've made and the path that you've picked, you're going to get the little bird chirping on your shoulder, and then you're going to find yourself confused.
Yeah, this family has. And honestly, I'm just also sad just to not be a part of their journey anymore, because they're really a wonderful family. And we're not all meant to agree, and that's fine. I just say that is what we're here for. We're here to help you be your sounding board through those times where it does get difficult to say, okay, but what about this? And what about this? Like I heard this on the radio the other day, or I heard my friends talk about this the other day. Like, even if you are starting to doubt what you're doing, like this is what we are here for. We're here to empower you. And if you honestly feel like we can't answer your question and it just no longer serves you, it just no longer serves you. Like, I mean, it is what it is.
And we always wish you well, right? I mean, yeah. We wish you well in your journey and be confident in decisions that you make, but also give it your all.
Right. Don't say that you have tried when you haven't met with us and when we have no idea what system that you actually have done to implement it. Like, have you set automations in place to ensure that you're actually running your cash flow the way that you ought to be if you're practicing IBC? Like, are you focused every single time? It's like, oh, okay, like what debt can I take over so that I'm in control of my debt this time? Like, how much interest can I claim back? If there's things that you're not actively doing on a week-to-week, month-to-month basis, don't say that you've tried IBC. Please, because you haven't.
Well, no, I want to speak to this being in the state of constantly borrowing and repaying. So if we go to Becoming Your Own Banker, page 41 in the 5th edition, Nelson he's talking about starting to build your own banking system. And he references, so this person's going to buy their new car every 4 years. So in order to buy the first one, they saved up money for the first 4 years and immediately started accumulating money again in the same savings account to prepare for the next purchase. Okay, so you're telling me that this dude worked for 4 years, saved up money in his savings account. He purchased his vehicle, but let's face it, that vehicle's not going to last you your lifetime. I mean, I guess depending on how old you are, but we're all going to need multiple vehicles in our lifetime. So as soon as he purchased that first car, what did Nelson say he did? He immediately started accumulating money again in the same savings account. If you have a dividend-paying whole life policy and you have funded your deposit options and you had cash value accessible to you, you took out a policy loan to, I don't know, buy a car, then the same function as you would if you saved up that money in your savings account and paid cash for that car, then you replenish your policy loan just like you do a savings account. This is where I feel like this particular family got caught up in the viewing a policy loan as a debt that is similar to having a debt at the bank.
It's hard to say. I think where this also gets lost is if you get to a point where you also have consigned that you don't need to actually check in with your thinking, because that's what we hold the space for the infinite banking lifestyle. And if you're not really willing to check your thinking, then this probably isn't going to be for you. With that being said, it's really tough because this family didn't. And so we could only speculate. It could have been a factor of were they also thinking well, we have a line of credit that we only have to pay 4% on, but policy loan is actually at a higher rate, that whole conversation. So there's that piece, right? That can, never mind them getting hung up on it, but
Yeah. And I think too, a piece that sometimes gets forgotten in situations like this is the death benefit piece. We had just last week, something that we walked through with a client regarding a death benefit. Whenever I was diagnosed with cancer, I remember being wheeled to the operating room and thinking, okay, well, if for some reason I don't make it out of here, I know that my family has the death benefit. And that was, I was determined I was going to make it out of there, but I knew that was that piece of the puzzle that would allow them to be financially okay. And if that doesn't mean something to somebody, I don't know, if you haven't stared death in the face, maybe it doesn't mean anything. Or maybe you don't see the reality of it, but I'm telling you, it's real.
And I challenge that thinking, especially to all those who give praise to Dave Ramsey and everything about buy term and invest the difference. It's such short-term thinking and short-range thinking because, you're not going to need the term once all your debt is paid. But I promise you, when you start getting into advanced estate planning, my goodness, you're going to wish that you would have kept some permanent insurance in place, especially if you want to see a lot of those assets that you're creating last further than your generation. You being wheeled into that operating room, you walked in there knowing that you had some permanent insurance in place, whether it's you before 40 or you at age 80, age 90, doesn't really matter. Our team, interestingly enough, because I've shared infinite banking for 16 years now, close to 16 years, coming up on that cusp. And I actually have spent most of my practice dealing with the living in all of this. And it's not very often that I've had to actually deal with having to do a death claim. Last week, Lacy, this was our first as a team together where we dealt with a death claim together. But before that, I had one death claim before. And it is so sobering because it reminds me of what the other aspect of what it means to have this license. It's not just a license for me to share the infinite banking concept for those that are here living, but it also means that we get to be there for when that loved one left behind gives us that call and says, my partner has passed away or my business partner has passed away. And man, it just puts so many things in perspective. I feel like I'm still processing, really.
Oh, 100%. Like I think we could do things to prepare for it, but the emotional side of helping a client through that, I don't think that you can process that in a day or an afternoon. And it also, we're the ones showing up for her with a blessing in her time of grief.
And interestingly enough, like like it or leave it, I always end up doing a bit of the math. It's like this one was a bit of a smaller policy. It wasn't something that we put in place because it was like, I don't know. This was like
1967.
Yeah, it was like over a 50-year-old policy or something like that, right? I just turned 50, so I couldn't have possibly put it in place. But it was one of those things where we calculated like this person put in about $12,000 over the course of the 50 years and is getting back just a touch over 3 times more than that. So dollars in, dollars out. You can just imagine if you're putting in way more than that into your policy, what you're leaving behind. But to the beneficiary, definitely is getting money tax-free, and it's definitely way more than what he put in over a course of time.
Right. Yeah. So there's so many pieces to this puzzle. There's the, how do we make our money work harder for us? That's usually the first piece of the puzzle when people come to us. How do we create our own banking system where we can rely less on the banks? And then it starts to go into, well, what is the long term? What are the death benefits? What is the generational wealth looking like? And then you know what, guys? One day it comes down to that processing that death claim. And we don't know when that's going to be, but none of us are getting out of here alive. And so all of these pieces to the puzzle make up the one big picture of what you can set up for your life now and for the generations to come.
So we're here for you. We're definitely here for you. And yeah, we want to help you live the best life that you can. And part of it is keeping as much money in your pockets as possible. And there is a way to do it. And all of it is hard. And choose your heart. And I think that our heart is the best heart because it is, I don't know, we're just biased.
We are. So you know what to do, guys. As always, head over to our website, ranchyourway.com, purchase your book bundle. That's where you're going to get started. It's where you're going to know whether this resonates with you and you want to look further into it. And so you can watch us on YouTube. You can listen to us on Apple, Spotify, or iHeartRadio. We would greatly appreciate a 5-star review and sharing our podcast with your friends. So I encourage you, keep learning with us. If you haven't listened to very many of our podcasts, go back to number 1 and start there. So until next time, bye guys.
So glad you leaned in with us on the Winnie podcast. We truly hope you're feeling more informed and empowered to take another step towards optimizing your financial life. Right now, make sure you hit subscribe so you can keep growing and learning with us. Until next time, we wish you prosperity in every area of your life.